Hello friends, today we are going to start accounting standards. Okay, we are going to take accounting standard 28 today, and we are also going to take other accounting standards like AS 15, AS 23, AS 25, AS 27. Today's topic will be AS 28. These five accounting standards have been added in the new scheme, which was not there in the old scheme. These standards were earlier there in the old CA final syllabus. They have shifted from old CA final syllabus to CA intermediate, and now it is a big challenge for the CA intermediate student to understand these complex accounting standards. Yes, my friend, these are a bit complex accounting standard. That is why it was not there in the previous intermediate syllabus. If you have not studied these standards earlier, then you have to focus. Today we are going to try to cover all these standards in detail. In order to get very good marks in the intermediate exam, first of all you require utmost conceptual clarity. Second, you need to have comprehensive material. You need to study different varieties of question. This will help you to get good results. You will pass in the first attempt. You will come in the merit list. You will make your parents proud. Okay. So with that objective, my name is Vinod Kumar Agarwal, All India rank 2 in CA Foundation, All India rank 4 in CA Intermediate, All India rank 24 in CA Final, Certified Public Accountant from USA, CPA. Okay, I hope you will take me now little seriously. Okay, the objective is not to tell you about my ranks and my degrees, but the objective is that you should be confident in your teacher. I have taught CA final for 21 years, CA intermediate for 21 years, and I have taught these standards at least 70 to 80 times. I hope now you will take me little seriously. If you want to have a comprehensive understanding of all the accounting standards, we have uploaded on our YouTube channel AS Foundation. You can go through it. My only request is you will not be able to understand the standard without having the book in front of you. You can purchase the accounting standard book from the office. You can go to our website vino.in and purchase. Plus you can purchase the entire video lecture which will cover your entire syllabus in detail, all questions covered in classroom, so that you can confidently go and face the exam and get very good results. Right. So let us start today accounting standard 21. Good morning to everyone. Let us start this journey of AS 28. AS 28 is called impairment of asset. AS 28 is called impairment of asset. What do you mean by impairment? Anybody, what do you mean by impairment? Can you explain to me meaning of this term impairment? Anybody, can you explain to me the meaning of the term impairment? So impairment means reduction in value. Impairment means reduction in value. Impairment means decline in value. Impairment means loss in value of the asset. Like when we say you are hearing impaired person, your hearing capacity has got reduced. If I am say your eyesight have been impaired, your eyesights have been impaired, your ability to view has been reduced. Now what is the concept behind this chapter, impairment of asset? If you understand this, you will be able to enjoy the topic. There is a company X Limited. This is the balance sheet of X Limited. On the asset side you have fixed asset of 500 crore. Then you go to take a loan from bank. When you go to take a loan from bank, what will bank do? Bank will look at your asset in the balance sheet, and bank will think that, oh, this company has got fixed asset of 500 crore, so let us give a loan of 250 crore to this company. The bank relied on the amount appearing in the balance sheet, thinking that the company has got enough asset. If company defaults, it will be able to recover the loan. But then what happened? One fine day the company defaulted. Bank goes to the company's premise. Bank takes control of that fixed asset. Now bank has to recover the money. What will bank do? Bank will sell. When bank goes to sell this fixed asset in the market, it is able to recover only 150 crore. So what is the loss to the bank? Loss to the bank is 100 crore. Is the bank going to lose money here? Yes, the bank is going to lose money here. Why the bank is going to lose money? Because it is not able to recover. What has gone wrong in this whole discussion? The whole discussion relied on the fact that this company has in the books, asset of 500 crore, and the bank relied on that and gave you a loan of 250 crore, thinking that it has got a margin, but it did not have that margin. This asset in the books was overstated. Before AS21, we did not have any other accounting standard which will force you to write down, which will make it mandatory to write down the value of the asset to its recoverable amount. Then the institute one fine day got up in the morning, and now they have made this standard mandatory. Any company whose value of fixed asset or intangible asset, if it goes below the recoverable amount, if the carrying amount goes below recoverable amount, then that company will have to compulsorily provide for impairment loss, will have to reduce the carrying amount of that asset to bring it down to its recoverable amount, so that the interest of investor, the interest of loan provider, the interest of shareholder, the interest of other stakeholders are protected. In the absence of the standard, companies could have fooled the investor. Now they cannot. So all of you, please come to paragraph number 1, objective paragraph. What was the objective of issuing accounting standard 28? So all the standards begin with objective clause. The first objective is that this will help you to calculate the amount of impairment loss, if any. It will help you to compute the amount of impairment loss, if any. And secondly, it will help you to do the accounting of impairment loss. First thing, calculation of impairment loss. Second thing, accounting of impairment loss. Third, if the value of the asset goes up subsequently, later on the recoverable amount increases because market conditions have improved, the standard also talks about reversal of impairment loss. So we are going to learn reversal of impairment loss also. How much impairment loss can be reversed by the entity. AS28 will give you step-by-step guideline how much impairment loss can be reversed by the entity. So what we have learned in the first objective paragraph, the objective of AS28 is to help you to compute the impairment loss, accounting of impairment loss, and reversal of impairment loss and its accounting. Scope paragraph. Accounting standard 28 says this standard is not applicable to certain assets. Why? They have already been covered by other accounting standard. If you have any doubt, you can ask me. Okay. Certain assets are not covered by AS28, like inventories. Inventories are covered by AS2, cost or NRV, whichever is lower. So if the NRV falls, automatically what will happen? You are going to reduce the carrying amount of inventory. Then similarly, asset arising from construction contract are covered by AS7. Investment covered by AS13. Cost or fair value, whichever is lower. So indirectly what they are saying, if the fair value goes down, the investment value has to be reduced. Deferred tax asset, that is covered by AS22. Deferred tax asset covered by AS22, for which the concerned accounting standard contains the relevant provision. So in AS22 you have studied, or you will study, that deferred tax assets are also written down when they are not recoverable. But that is not the objective of today's lecture. Our lecture today is for impairment of asset covered by AS28. So these are not covered because there are specific standard. This standard is applicable to both types of assets. Those which are carried at cost, that is cost model. For example, property, plant, equipment and intangible assets are accounted using cost model, and those which are carried at fair value, for example, property, plant, equipment valued using revaluation model AS10. In AS10, PPE can be measured using revaluation model. So even the assets which have been revalued upward are covered by the standard. Even assets which are accounted using cost model are covered by this standard. So that is the scope part. First thing you have learned, not applicable to certain assets covered by other standard like inventory, construction contract, deferred tax asset or investment. Second thing you have learnt in scope paragraph, the standard covers assets carried at cost also and assets which are carried in the books at revalued amount also. Now we come to certain important definitions. Why? Because once you are clear with the definition, then they will be used in the standard. For example, I ask you, what is the carrying amount? And you will look at here and there. There is a meaning of carrying amount in all the accounting standard, and that is, you will take the cost of the asset, the amount at which the asset was initially capitalized. You will study this under AS10 or AS26. AS10 deals with property, plant, equipment, tangible fixed asset, and AS26 deals with intangible asset. Either you have already studied or you will study how to compute the cost of PPE or intangible asset minus any accumulated depreciation, that is depreciation provided till date, and minus any accumulated impairment loss. If the asset was impaired earlier, possibly, then you have to deduct the accumulated impairment loss provided till date. An asset can be impaired more than once also. So if earlier you have impaired, that is accumulated impairment loss. So this is A, B, C. Carrying amount will be A minus B minus C. Let us take one small question 1 for understanding the carrying amount. Okay, carrying amount, find out the carrying amount. ASF Limited purchased a machine for 5 lakh. Accumulated depreciation is 1,50,000. Cost is 1,50,000. Accumulated depreciation 1,50,000. My question is, what is the carrying amount? Cost minus accumulated depreciation. What is the carrying amount? Would you please reply? Can you please reply? What is the carrying amount? Anybody? calculation of carrying amount. So you will write cost 5 lakh less accumulated depreciation up to the date you are providing impairment. You are calculating carrying amount, compute the depreciation, and now the balance is called carrying amount 3 lakh 50,000. If you have to check whether the asset is impaired or not, you will compare carrying amount with recoverable amount. You will compare carrying amount with recoverable amount. You will not compare cost with recoverable amount. You will compare carrying amount with recoverable amount. So the next thing you have learned, carrying amount is cost minus accumulated depreciation minus accumulated impairment loss. Another concept we have to learn is recoverable amount. In order to calculate impairment loss, I need to compare carrying amount with recoverable amount. So what is recoverable amount? Recoverable amount underline is higher of the two. Recoverable amount is higher of the two. Compute the net selling price. Net selling price means your sale price minus cost of disposal. Selling price minus cost of disposal. Cost of disposal would be, for example, brokerage, commission, okay, transport, then uninstallation cost, dismantling cost. All this you have to reduce to calculate the cost of disposal. Deduct cost of disposal from selling price, that will give you net selling price. So that is what you will realize in your pocket if you sell the asset, net selling price. And secondly, value in use. Value in use means if you continue to use the asset, how much is the value you will get from the use of asset, and it is the present value of future cash flow, present value of future cash flow from use of the asset, present value of future cash flow from the use of the asset plus present value of salvage value you will realize at the end of useful life, which means the student has to learn calculation of present value. Some knowledge of present value calculation will be required in this chapter. Some knowledge of present value would be required. I will explain whenever we'll come to this. So once again I am asking you a question, reply fast. How do you compute recoverable amount? Recoverable amount is higher of the two. Net selling price, which is gross selling price minus cost of disposal. Value in use, that is present value of cash flow from the use of the asset plus present value of salvage value you will realize once the asset is disposed at the end of its useful life. That is how we will compute value in use. Now the next question is why we are taking higher of the two. Why we are taking higher of the two? Any guesswork? Why we are taking higher of the two? Why not lower of the two? What a businessman will do? What a businessman will do? If a businessman has got an asset, he will take that decision which is more profitable, the one which is more profitable. What is more profitable? If by selling the asset he gets more amount, suppose this will give him 100 rupees, but by using the asset, the value in asset is 120. By using the asset, the present value of future cash flow is 120. I would prefer to use the asset. I would prefer to use the asset. And therefore, the standard looks at the decision making of a businessman. How a businessman would react given a choice between selling and continuing to use. He would decide that option which is more beneficial. If selling price is 120, but by using the asset and getting present value of only 100, I would prefer to sell the asset. So therefore the standard say take higher of the two. Whether you actually sell or not is not my concern. My concern is how to reach recoverable amount, and then we'll take higher of the two. I hope the logic of higher of the two is clear. Say yes or no. Say yes or no. Is the logic of higher of the two clear? Now the next is, I have given you a small summary of how to reach net selling price and how to reach value in use, because the success of this standard depends on these two numbers and further calculation. To calculate net selling price, okay, to calculate the net selling price, suppose this is my calculator, okay, and I want to find the net selling price, or suppose this is my laptop, I want to compute the net selling price. How do I do it? So the standard says first preference will be price in a binding sale agreement in an arm's length transaction. Have you entered into a binding sale agreement? A binding sale agreement means legally enforceable agreement. You cannot withdraw from the agreement. If yes, take that. And it should be an arm's length transaction. No force, no coercion. Okay. Price is determined in a free atmosphere without being undue influence. So it should be fair value, like how two buyer and seller would interact and close the deal without any threat, coercion, undue influence. Okay, this price should be adjusted for incremental cost attributable to disposal of the asset. So you will first find out the sale price from the binding sale agreement minus any disposal cost. Any cost to dispose the asset will be deducted. If suppose you don't have binding sale agreement, then you go to second preference. So second preference is market price. Go to the market. Go to the market. Check whether the similar asset or same asset is being traded in the market. Find out the bid price or most recent price. If the same asset is traded in the market, then you can take that minus cost of disposal. If suppose the same asset is not traded, similar assets are not traded, then we'll apply the third preference. What was the first preference? Price in a binding sale agreement in arm's length transaction. Second preference is market price minus cost of disposal. But because the asset may become very old, this computer is suppose, or calculator is 10-year-old calculator, I will not get a similar market where this calculator is not sold. It's very old. So therefore what I'll do, I will have to make the best possible estimate of the selling price. I have to make the best possible estimate of the selling price by referring to some similar transaction, something which will help me to arrive at the net selling price. Let us revise. First preference, binding sale agreement in an arm's length transaction. Second preference, market price. Third possible, best possible information available. Now the next is how to compute value in use. For value in use, I need to estimate future cash flow. Future cash flow will include both inflow and outflow. So if you have an asset, estimate how much will be cash inflow, how much will be cash outflow, how much will be sale, how much will be cost of sale, expense, etc. Okay, from the use of the asset and from its ultimate disposal. So estimate the future cash flow, estimate the salvage value at the end of useful life, and then because the asset will generate cash flow in future, the standard says you need to find out the present value, because I need to compute value in use today. VIU, value in use today. Cash flows are in future. Therefore, we need to find out the present value by using discount rate. Present value means finding today's value of a future cash flow by discounting it by an appropriate discount rate. Okay, I will tell you how to do it in next few minutes. So that is how value in use is calculated. But there is a problem here. What is the problem here? Estimating future cash flow is a problem. That is an area where the standard gives you guideline how to estimate the future cash flow. Of course, estimation would involve subjectivity. It can be manipulated by companies in some cases, but there is no other way. When you are estimating about future, there is going to be some estimation error, but the standard says we do make estimates in our business. We prepare budgets. Based on that, we allocate resources. Is it not estimate? Can it not go wrong? We submit loan proposal to the bank. We submit loan proposal to the bank, which is based on estimates. Don't you think this can also go wrong? So when you can prepare budget based on estimate, when you can prepare loan proposal based on estimate, why can't you calculate value in use? Stop giving excuse, compute value in use. Stop giving excuse, compute value in use, because you do estimate your future income expense by preparing budget. You take loan from the bank by preparing estimated budget of P&L account, cash flow statement and other thing. Let us solve question number 2. Question number 2 is the carrying amount of a building in the books of Sun Limited is 300 lakh. Carrying amount is 300 lakh. On that date, value in use is 250 lakh. Net selling price is 238 lakh. Value in use is 250 lakh, net selling price is 238 lakh. Now the question is calculate the recoverable amount. Calculate the recoverable amount. So how do I compute the recoverable amount? Recoverable amount is higher of the two. One is net selling price and second is value in use. So first you read the problem. Net selling price 250 lakh, tick mark. Tick mark in the book. Value in use 238 lakh, tick mark. Which is the higher of the two? Which is the higher figure? 250. So you will say recoverable amount is 250 lakh. So my answer was 250 lakh. Now another concept is value in use. I have explained this to you. You will find in your book it is all written. Value in use means present value of estimated future cash flow expected to arise from the use of the asset during the remaining useful life and present value of disposal value at the end of the useful life. So this is present value of two things: cash flow from use of the asset plus present value of salvage value at the end of useful life. If you use the asset, you are going to generate two types of cash flows. One, you are going to get cash flow from using the asset, sale minus expense. Once the useful life is over, you are going to dispose the asset and you are going to receive the salvage value. So we'll now solve one question number 3. All of you will also participate in solving question number 3. X Limited is having a plant, that is asset, having a carrying amount which is rupees 100 lakh. Carrying amount is 100 lakh. On 31st March 2004, balance useful life is 5 year. It will generate cash flow for 5 more year. Residual value at the end of 5 year is 5 lakh. Residual value after 5 year is 5 lakh. Estimated future cash flow from using the plant. By using the plant, you are going to generate following 5 year cash flow. This will be generated in future year. This need to be discounted. Plus this 5 lakh rupees also you will get after 5 years once the useful life is over. Question is, calculate value in use for plant if the discount rate is 10%. That means present value will be calculated using 10% discount rate. 10% is your discount rate or your cost of capital. Okay. And also calculate recoverable amount if the net selling price is 60 lakh. If the net selling price is 60 lakh. So we are going to calculate two things. One is value in use. Second is recoverable amount. Question is important. Taken from the study material. Okay. So first we'll compute value in use. First we'll compute value in use. To calculate value in use, we'll draw the three columns: year, cash flow, present value at the rate 10%. You can use present value factor also, or you can directly calculate the present value. So first you draw this table: year, cash flow, present value at 10%. 5 years are there. Refer the question. You will find they have given you cash flow year 1 50, 230, 330, 220, and year 5 20 cash flow from use of the asset, 5 cash flow from salvage value. Therefore total cash flow is 25. This 5 is salvage value, which is printed in the question second line. Now I am going to tell you how to compute the present value. Are you ready? Keep this calculator ready. Let us revise what we have learned in school level mathematics. Present value is equal to future value. You can write it also if you want, upon 1 plus rate of discount to the power n. That means if you receive 1 rupee after 1 year, what is its value today? That is present value. Let us say you receive 1 rupee after 1 year. So this 1 rupee after 1 year includes interest. In year 0, which we will call today, what is the present value? That means if you invest some amount today, with interest it becomes 1 rupee after 1 year. So how much you need to invest today? How much you need to invest today if your discount rate is 10%? So you will take your calculator, 1 divided by 1.10, because 10% is the interest rate. So if you have 1 rupee, it becomes 1.10 after 1 year. So the factor will be 1 divided by 1.10 is equal to, you get 0.9091. What is 0.9091? If you get 1 rupee after 1 year, and if your discount rate is 10% or interest rate is 10%, it is equivalent to 0.9091 today. Now we will learn to cross check. If you have 0.9091 and if you earn 10% interest on that, how much you will have after 1 year? Add 10%, 0.9091 0.9091 plus 10% if you do, you will get 1 rupee, which means your calculation is correct. So this is how we compute the present value. So let us solve now. Calculate the present value of 50 rupees which you will receive after 1 year. So please type on your calculator 5050 divide by 1.10 equal to, you will get 45.45. Memory plus, because I have to take the total. Memory plus, again type 30 divide by 1.10, 2 times equal to, you will get 24.79. Memory plus, one more time, 30 divided by 1.10, 3 times equal to, you will get 22.54. Memory plus, then type 20 divided by 1.10, 4 times equal to, you will get 13.66. Memory plus, and then 25 divided by 1.10, 5 times equal to, you will get 15.52. Memory plus. Now you have to add this last column. If you have to add, and if you have used memory plus function, press MRC function. Press MRC function and you will be happy to note your calculator is showing 121.91. So that way you can save time. This is called value in use. Present value of future cash flow. Value in use. Am I right? Step 2, write down. Step 2, recoverable amount. Recoverable amount is higher of first A, value in use, as per step 1, value in use 121.91. Net selling price is given in the question, right? Given 60, which is higher of the two. Value in use is higher, therefore recoverable amount will be 121.91. So this is your study material question, and if you solve in detail you will get full marks. Have you noted? Have you noted? Say yes. So the answer is recoverable amount is 121.91 or 92 lakhs. Now we are going to understand one more important concept called impairment loss. Printed in your book you can see impairment loss. What is impairment loss? Is the amount by which carrying amount of an asset exceed its recoverable amount. Carrying amount of an asset is more than recoverable amount. Example, carrying amount is 150, recoverable amount is 100. So in your book you are showing the asset at 150 whose recoverable amount is 100. Therefore there is an impairment loss. Asset recoverable amount has gone down. So my answer would be impairment loss is equal to carrying amount minus recoverable amount. So in our answer impairment loss will be 50. Now one more thing you understand, if carrying amount is 100, recoverable amount is 150, then what is impairment loss? Please reply fast. What is impairment loss? If carrying amount is 100 and recoverable amount is 150, the answer is impairment loss is 0, because your recoverable amount is more. If recoverable amount is more, there is no impairment. Enjoy life. Next page we have made a small summary. Impairment loss is equal to carrying amount minus recoverable amount. Then recoverable amount is higher of net selling price and value in use. And then there is a carrying amount. Carrying amount is cost minus accumulated depreciation minus accumulated impairment loss. So this is the summary of what we have done till now. Is it right? Next point is point number 4, identification of impairment. Identification of impairment. Now there are big companies, huge companies, they have got thousands of assets. Are you going to apply impairment accounting every year? The standard says no. Only if there are indication of impairment. If you find that probably the asset recoverable amount might have gone down, indication of impairment, then you will first compute recoverable amount. So first is check if there is indication of impairment. Suppose you think that there are indication that assets carrying amount is more than recoverable amount, then step 2, calculate recoverable amount. I will use RA for recoverable amount, and then if recoverable amount, or I will say if carrying amount is less than recoverable amount, then provide impairment loss. Then provide impairment loss. If there are indication of impairment, don't provide impairment loss. First calculate RA. If carrying amount is, sorry, I have a small correction here. If carrying amount is greater than RA, if carrying amount is greater than RA, then provide impairment loss. Okay, don't directly provide impairment loss. If carrying amount is greater than recoverable amount, then provide impairment loss. But suppose in step 2 you compute recoverable amount and recoverable amount is more than carrying amount, then there is no need to provide impairment loss even if there are indication. Now the next issue is, how do we get indication? As per the standard, the indication can come from external sources or internal sources. External means outside the organization. External indication means something from outside the organization you found that, which gives you a hint that the asset might be impaired. An internal indicator means from within the organization. From within the organization we got some hint, we got some indication which shows that there is a possibility that recoverable amount is less than carrying amount. Okay, so let us read the example of external indicators. Example of external indicator: significant fall in the market value of the asset. Your carrying amount of the asset in the book is 1,50,000. You go to the market and the same asset is now, you found on the display, same asset is having a market price of 1 lakh. It happens. Like for example, you purchased a mobile phone for 1,50,000 and after 6 months you found that, oh, it is now selling for only 1 lakh. It is an indication of impairment, because in your book that mobile is appearing at 1,50,000 minus say depreciation 10,000, 140, but the same mobile phone is now available for 1 lakh. So what is the indication? The indication is that it might be impaired, and for that you have to first compute recoverable amount. So this is one very good indicator from external sources. Second is significant change in technology. Your company manufactures diesel car Now the technology is moving towards EV. Less people are buying diesel car now. More people are preferring to buy electric vehicle. Okay, therefore a company manufacturing a diesel car, which is a car based on diesel technology, will find that its value in use has gone down as there is less demand for that product. Same thing happens in case of companies manufacturing mobile phones. Same thing happens in company manufacturing mobile phones, because after some months or maybe 1 or 2 years, the technology might change and the value in use can go down. Okay, then there is a change in market situation. There can be fall in demand. Okay, fall in or change in customer preferences, change in taste and fashion. What happens because of this change in customers' taste, fashion, okay, preference, fall in demand, recession? The demand for the product may go down. If the demand for the product is lower, which means value in use will fall, and if value in use will fall, there is an indication that there can be impairment loss. Okay, so think about these examples. There are customer whose taste, fashion keeps changing with respect to clothes, with respect to eyewears, shoes, clothing, okay, perfumes. The taste, fashion keeps changing, and because of that the value in use can drop. Third is economic or legal condition. Economic conditions can change. There can be high inflation, because of which there is a lower demand, because of which there is a high cost of input. There can be a recession, economic recession, demands are falling. These are indication that the value in use might have gone down for your company. And one interesting thing, legal requirement can also change. The government says diesel cars will not be allowed in this state. The state government says diesel car will not be allowed in this state. This is a legal requirement. A truck whose life is more than 15 years will not be allowed on the road. Companies selling tobacco will not be allowed. Companies selling liquor will not be allowed. Company manufacturing plastics will not be allowed. Company cannot import certain material which is critical raw material, because the law has changed. Company cannot export to certain countries, but your business depends on that. Law has changed. Change in law can be a big time indication of impairment if your business is affected negatively because of that change in the law. Okay, so these are external indicator. So look for any legal change, demand change, technology change. Point number next, interest rates have increased. Market interest rates have increased. Because of that, the discount rate you are using has also increased. And if the discount rate you are using has also increased, because of the increase in the market interest rate, the value in use will fall. Higher the discount rate, lower the present value. I will show you. You come back to your question number 3 which you have solved. I'll go behind to just explain to you. Please have a Have patience. Now look at this calculation. This is based on 10% discount rate. Suppose interest rates have increased and now my discounting factor is 20%. See what will happen. Your value in use, which was 121.91 earlier, will decrease. So let us try and prove this point, otherwise you will not understand. If market interest rate increases, because of which the discount rate which I was using also increases, value in use will fall. Try 50 divided by 1.20 equal to memory plus, that is 41.67. 30 divided by 1.22 times equal to memory plus 20.83. One more time, 30 divided by 1.23 times equal to memory plus 17.36. 20 divided by 1.24 times equal to memory plus 9.65. 25 divided by 1.25 times equal to 10.05. Memory plus memory recall, you will find it is now 99.55. This is an example to prove that if the market interest rate increases, because of which if your discount rate also increases, the value in use can drop. If the value in use can drop, like in this example, suppose I change the value in use from 121.91 to 99.55, you will find my recoverable amount has also gone down. And if my recoverable amount has gone down, there is a possibility that the asset might be impaired. Yes or no? Suppose earlier, only for understanding, I hope you are attentive. If you want to have intellectual understanding focus, earlier suppose carrying amount was 110 and earlier recoverable amount was 121.91, I will say no impairment. But now with the change in discount rate, my recoverable amount is 99.55, so I will say yes, there is an impairment, and I will have to provide for impairment loss of 10.45. 110 minus 99.55. Oh my God. This example was given to demonstrate, to make it conceptually 200% clear how increase in interest rate can lead to impairment loss. Earlier when interest rate was 10%, there was no impairment. Now when the interest rate has increased to, let's say, 20%, there is an impairment. Oh, so this point I hope you have understood with example. And now next is point number 4, external indicator. Carrying amount of the net asset is more than its market capitalization. Sir, what is market capitalization? Number of securities into market price. Number of securities into market price is called market capitalization. That means market value of all the equity share. Market capitalization means market value of all the equity shares of the company. Let us understand with the help of example. This is the balance sheet of a company. Asset side 100, liability 20, and equity 80. So what is net asset? Net asset is asset minus liability 80. So as per the books of account, this is the balance sheet. As per books of account, its net asset is 80. And what is the market value of all equity shares? Suppose the market value of all equity share is 60. Market value of all the equity share is 60. When the book value or net asset is 80, and if the market value of the entire business is 60, what does it indicate? It indicates that the market is not willing to pay you an amount which is equal to your net asset. Market have got the hint. Something is wrong with this company. This company's net asset is overstated in the book. Hence, the market value is below net asset. So this is an indication of impairment. Indication of impairment. If market value of all the equity share is less than net asset, then this is a clear indication of impairment. We can also say market capitalization. We can also say market capitalization upon book value of net asset is suppose less than 1. Market capitalization to book value of net asset is less than 1. If this ratio is less than 1, it is an indication of impairment. So they will ask you such question in the exam also, that a company's market capitalization to book value is below 1. What does it indicate? It indicates that possibly there is an impairment. Possibly there is an impairment. Okay, so this were external indicator. Second, right side, internal indicator. That is, from within the organization, we will get to know that the value of the asset have gone down. For example, asset has become obsolete. Asset has become obsolete. So you have a computer, but this computer is old version. Okay, now it does not support the new software, the new operating system. You can't use new software on this computer. It is very slow. It doesn't support the latest office version or whatever, which means it has become obsolete. And if it has become obsolete, its recoverable amount must have gone down, or the asset has suffered physical damage. You have an asset which have dropped, because of which there is some damage. It's an indication of impairment. That means now in the damage condition, the value of the asset is lower than what it was before. It's an indication of impairment. Second indication is significant internal changes adversely affecting the operation of an asset, like plan to discontinue, plan to restructure, or plan to disposal. If management is involved in such activities like restructuring, discontinuation of operation, disposal of a business segment, these are indication of impairment. So if management is planning to bring some restructuring exercise that might result into selling some business operation, stopping some activity of a business, it is an indication of impairment. Last but not the least, internal evidence that performance of an asset will be worse than expected. What do you mean by that? It means that the budget was to manufacture 5,000 unit, example. That was my planned performance from the asset, but the actual output is 2,000 unit. What does it indicate? The machine is producing much lower than what it was planned to manufacture. These are indications that the asset might be impaired. So once you get the indication that asset might be impaired, again come back to this flow chart. Once you get the indication that the asset might be impaired, sit down and compute recoverable amount. And if you find that carrying amount is more than recoverable amount, then provide impairment loss. But if you find that recoverable amount is more, in spite of having impairment, there is no need to provide impairment loss. There is no need to provide impairment loss. Okay, now we'll solve one question number 4. The students have to quickly reply option A, impairment. You have to participate. Just write A and B. And option B, no impairment. Suppose this comes as a multiple choice question with 2 options. You will have to answer. You will either write A or B. A means impairment, B means no impairment. The following information is available as regards the fixed asset of a company. Are there any indication of impairment? So you have to say yes or no. First point A, carrying amount in the balance sheet net of accumulated depreciation is 340 lakh. Assets are 2 years old. The present market price of the asset is 300 lakh. The company charges 10% straight line method of depreciation assuming 10-year useful life. So in short, carrying amount is 340 lakh and the market price has gone down to 300 lakh. Whether there is indication of impairment, external indication, point number 1. Tell me yes or no. Yes or no. Whether there is external indication of impairment when the market price is 300 and carrying amount is 340. Please reply. Whether there is indication of impairment. Yes or no. Waiting for your answer. Say yes or no. So the answer is yes. There is an indication of impairment because market price is below carrying amount. First answer is there is an indication of impairment because market price is less than carrying amount, which I have written in the book also. Second point, estimated useful life of the asset has been reduced to 5 years. Henceforth, because of technological changes. Earlier it was 8 years. Useful life. Earlier 8 years. Now 5 years. Due to change in technology. Is this an indication of impairment? Is this an indication of impairment? The answer is yes. Because the asset was earlier supposed to generate cash flow for 8 years. Now it is going to generate cash flow only for 5 years. So that is an indication of impairment. Okay, so the answer is yes. Indication of impairment exists. One more chance. Please reply fast. One more chance. Market rate of interest has increased. I have taken this example to prove the point. Accordingly, there is an increase in discounting factor from 14% to 15%. Higher the discount rate, lower the value in use. Higher the discount rate, lower the value in use. So the answer is yes. There is an indication of impairment because if the discount rate increases, value in use will decrease. And if value in use will decrease, there is a possibility that there is an impairment. There is a possibility that there is an impairment. You have to sit down and compute, but at least you got the indication. Last but not the least, market capitalization to book value ratio is 0.80. market capitalization divided by book value if it is less than 1, which is 0.80 in the question, the answer is yes. There is an indication of impairment because the market value of all the equity share is below their net asset or book value. In all four cases, the answer is yes, there are indications of impairment. So what do you do? When there are indication of impairment, compute recoverable amount. Recoverable amount is higher of the two, value in use and net selling price. And then if the recoverable amount is lower than the carrying amount, you will provide for impairment loss. So that is the theme of this chapter. So the answer I have printed in the book, you can just read it. Paragraph number next. Measurement of recoverable amount. How to calculate recoverable amount. To compute recoverable amount, you have to compute three things. To compute recoverable amount, you have to compute three things. Okay. You have to first compute carrying amount. Compare with, suppose, net selling price. If net selling price is greater than carrying amount, there is no need to compute recoverable amount, because if net selling price is higher than carrying amount, recoverable amount will definitely be more than carrying amount. And if recoverable amount is definitely more than carrying amount, there is no impairment. So don't waste your time and compute value in use. I will make a small correction. There is no need to compute value in use. The moment you find net selling price itself is more than carrying amount, do not take efforts and find out value in use. Whatever may be the value in use, your asset is not impaired. Recoverable amount is higher of the two, net selling price or value in use. If one of them is higher than carrying amount, the recoverable amount is automatically higher than carrying amount. For example, carrying amount is 100, net selling price is 150. So net selling price is more than carrying amount. Whatever may be the value in use, suppose value in use is 60, recoverable amount will still be 150, which is more than carrying amount. Hence there is no impairment. Do not waste time in calculating the second component of recoverable amount. Okay? Or compute carrying amount, compare with value in use. Suppose you have computed value in use first. And you found value in use is more than carrying amount. There is no need to compute net selling price. Because if value in use is more than carrying amount, asset is not impaired. Recoverable amount must definitely be more than carrying amount. Do not waste your time, energy, resource in finding the net selling price, because it takes time, it takes effort, it takes energy, it takes resource. So when one of the two component of recoverable amount is more than carrying amount, there is no need to compute the other one. Now the next issue is First, always try to calculate recoverable amount of individual asset. First, always try to compute recoverable amount of individual asset, single asset. Like, for example, you have a car, taxi. One single taxi you have, which is given on rent, used for rental business. So what you will do? You will compute carrying amount from the books. You can compute recoverable amount by finding its net selling price and value in use. Possible. You have a single bus. You can compute all the three variables required for a single bus if you are running a bus business. But suppose this is a factory. This is a factory. In factory you have 10 machines. You have equipments. You have furniture. Okay, you have electrical items. All of these are working together to produce any finished product now. If you have to compute the impairment or if you have to compute recoverable amount of a machine which is working along with other machine, equipment, computer, furniture, you can't compute its value in use. You can't compute its value in use because it does not generate cash flow independently. So my note says first try to compute recoverable amount for a single asset. If you can compute its value in use, net selling price, carrying amount you can, but sometimes we can't compute value in use. If no, then my second step would be calculate recoverable amount of cash generating unit. So today you understood one more, you will understand one more concept called cash generating unit. What is cash generating unit? Cash generating unit means a group of assets which together generate independent cash flow. A group of assets which together generate independent cash flow. Like this factory. In this factory you have machines, you have equipment, you have computers, furniture, etc. Okay, these all together work and produce output which is sold in market, which is capable of sold in the market. Then this factory will be called cash generating unit. Factory will be called cash generating unit. Is it right? Because it is able to generate independent cash flow. It is able to generate independent cash flow. So the word independent underline in paragraph 7. If it is dependent on other asset or other cash generating unit for its own cash flow, then it is not independent cash flow. And then we have to go to next higher level of CGU. So how do we do impairment calculation? First, single asset. If you can find out net selling price, value in use for single asset. If no, then go to smallest group of asset. Let us call it CGU, small CGU. But if you can't find a small CGU which generates independent cash flow, then you go to larger CGU, a bigger group of asset which generates independent cash flow. Is it right? Which generates independent cash flow. If you can't find a larger, go to again next higher level. Okay, maybe the enterprise. The whole enterprise can become a CGU. So you have to start with single asset if you can find value in use independently, cash flow independently. Otherwise, go to small CGU. If that is also not available, go to larger CGU. If that is also not available, then you go to the enterprise level. Find out a group of asset which generates independent cash flow and test that group for impairment purpose. So I hope you have understood till now. Net selling price I have explained to you on the first page. Future cash flow. Come to next paragraph, future cash flow. This standard has got one weakness. It asks you to estimate future cash flow. It asks you to estimate future cash flow, and that is where the weakness lies, because companies can estimate higher and higher amount of cash flow to ensure that they do not have to provide for impairment loss. Keeping that in mind, the institute has given some guideline how to estimate future cash flow. So for calculating value in use, paragraph number 9, net cash inflow should be estimated over the useful life. This I have told you. Estimate the remaining useful life, estimate the cash flow. While estimating cash flow, give more weightage to external evidence. For example, the government data, industry wise data. Okay, government publishes growth rate for certain industries. So government data can be used for understanding future prospects of that business. Industry wise data are also published, one can refer them, or you can use the most recent budget or estimates of the management. Okay, because every company prepares budget for its resource planning, for its future planning. The standard says the budget or estimate should not be more than 5 years, unless you can write unless a longer period can be justified. So you should try to estimate cash flow only up to 5 years, but if you can justify a longer period, you can. If you have got a right to collect toll on highway for 20 years, right to collect toll on highway for 20 years, then one may take a 20-year period cash flow, okay, if it is available. Or if you have got a right to generate power for 25 years, then you can take 25-year estimated cash flow. Okay, for the later part of the projection should be made by extrapolating, considering generally a steady or declining growth rate. After 5 years, assume that growth rate will either become stable or growth rate will decline. And if possible, you can also assume zero growth rate or negative growth rate, because after 5 years, lot of competition will enter the industry. First 5 years you may have a high growth rate of business, but you can't sustain a high growth rate forever. So maybe the growth rate will start declining. The growth rate will become either declining, stable, or it may become zero. That is, you will not be able to generate higher cash flow beyond 5 years. So that you have to take into consideration. Second paragraph or next paragraph number 10 is effect of inflation. All of you know what is inflation. Increase in the price level. Now, here one important rule is there. What is that rule? Number 1, if discount rate includes the effect of inflation, discount rate includes inflation, then matching cash flow will also include inflation. In order to match cash flow with discount rate, both should have effect of inflation. For example, your real interest rate is 10% and inflation is suppose 5%. So nominal discount rate will be say 15%, which means discount rate of 15% includes inflation. Okay, so while estimating cash flow, suppose you are thinking that next year cash flow will be 100 rupees, you will add the effect of inflation also 5 and make it 105. If second year you are estimating will be 200, then you will add the effect of inflation, let us say 10 rupees, so make it 210. If you are using 15% discount rate, cash flow should include effect of inflation. If you are using 10% discount rate, that is without including inflation in the discount rate, cash flow should also be excluding the effect of inflation. So I'll just speak again, written in the book. If discount rate includes the effect of inflation, cash flow will also include the effect of inflation. If discount rate excludes the effect of inflation, cash flow will also exclude the effect of inflation. Paragraph number 11. Future restructuring or capital expenditure. We have got an asset today. Management want to restructure this asset in future. It wants to bring some changes, modification in the asset in future. Will you consider the effect of restructuring of the asset while estimating future cash flow? Because if you restructure the asset, the future cash flow will improve. If you restructure the asset, the future cash flow will improve. The answer is no, unless the enterprise has committed to restructuring. Future restructuring will be not considered unless the enterprise has committed to do future restructuring. And similarly, management want to incur capital expenditure. So you have a machine, you want to upgrade it by adding some more feature in that. In future, not now, after 2 years, you want to upgrade it. Will you consider this upgraded machine while estimating the cash flow? The answer is no, unless the capital expenditure for upgradation has been incurred. So if you are only wishing to upgrade, if you are only wishing to restructure and there is no commitment, there is no expenditure incurred, please ignore the effect of such restructuring or such capital expenditure while estimating the future cash flow from the asset. Okay. What about financing cost like interest? Financing cost like interest and preference dividend will not be considered. We want to only consider the cash flow related to use of the asset. Financing cost like interest and preference dividend are not related to use of the asset. And what about taxation? Do not consider taxation also while estimating cash flow. Finance cost and taxation will not be considered. That means cash flow should be before finance cost and taxation. Cash flow should be before finance cost and taxation. Cash flow should be before finance cost and taxation. Is it right? So interest will not be deducted in computation of cash flow. Preference dividend or equity dividend will not be deducted in estimating the cash flow. Any income tax paid will not be deducted in estimating the cash flow. Next point is foreign currency cash flow. Oh my God. You may have an asset which generates cash flow in foreign currency. You may have an asset which generates cash flow in foreign currency. You may have an asset in USA. For example, it may generate cash flow in US dollar. You may have an asset in USA. Cash flow is generated in US dollar. So first you will estimate cash flow in US dollar. Let us say these are the projected cash flows. These are the projected cash flows in US dollar. Then you first compute present value by using the discount rate applicable to US dollar. Calculate the present value using the discount rate applicable to foreign currency. Now here one thing we need to understand, different country may have different discount rate. In India, the inflation is very high, interest is very high. So in India, discount rate is also very high. But in USA, the inflation is very low. So discount rate is also very low. So maybe I will discount it at 8% and I will arrive at present value. Let us say it comes to $85. The present value of this future cash flow discounted using US interest rate of 8% comes to $85. So what I'll do, our books of accounts are maintained in Indian rupee. I will convert into rupees. How do I convert into rupees? By multiplying rate of exchange available today, spot rate, or today's exchange rate. So today exchange rate is suppose 80 rupees. So the present value of cash flow will be 85 into 80, that is 6,800 Indian rupees. So I will revise for you. First thing, if your cash flows are in foreign currency, compute the present value by using foreign currency discount rate, which may be different from the discount rate in India. After computing present value, multiply by the spot exchange rate, today's exchange rate, that will give you value in use in Indian rupees. So let us take a question on that. All of you will come to question number 5. This amazing chapter, question number 5. This question is given to clarify the concept. I don't need to praise myself, but we have taken lot of questions from other reference books that will help you to understand each and every concept. Your study material does not contain so many questions. If you want only study material question, you can do only that much, but that will not help you in the exam. If you want to do time pass, you are most welcome, but then it will not be something good for the exam. Exam is of a different level. You have already studied so much. Why to take a chance? Study more, learn more, revise more, reproduce more, and score more. Learn more, revise more, score more. Let us go to question number 5. A Limited has a machine in USA. Following details are given. Year 1, 2, 3, 4. Cash flows are given in dollar. Exchange rate is also given to you between Indian rupee and US dollar for different years. Now the important line is this one. Weighted average cost of capital, that is discount rate, to be used. In USA is 10% and the weighted average cost of capital in India is 11%. So what I'll do, First, these cash flows in USA dollar will be converted into present value using 10% discount rate. You will get PV in USD, and that will multiply by exchange rate today 70, and you will get PV in Indian rupees. This PV in Indian rupee is your answer, value in use today. So please write down answer. Answer, write down step 1, calculation of value in use. Calculation of value in use. Year, cash flow, PV factor at the rate 10%. 10% is USA discount rate. After that, write down year 1, 2, 3, 4. Cash flow in dollar. Cash flow in dollar. Cash flow in dollar is 1,000, 1,200, 1,500, 1,600. And now compute the present value on your calculator. All clear first. Follow me. 1000 divided by 1.1 equal to. So you will get 909.09. Press memory plus function. Press memory plus function. Okay. Can you see that? Now you press 1200 divide by 1.10, 2 times equal to. You will get 991.74. Press memory plus here. Now you try 1500 divide by 1.10, 3 times equal to. You get 1126.97. Memory plus. Then 1600 divide by 1.10, 4 times equal to. You will get this number 1092.82. Memory plus. And now memory recall function you will press. There is a memory recall function. You press that. You will get same 4120. You can see 4120. That is how you compute the present value. Okay. This is in dollar. This what you have computed is in dollar. And now spot rate is 70. Spot rate is 70. So multiply by 70. You will get 288,443.40. 288,443.40. This is my value in use. This is my value in use. I hope you are getting it. So if you are given cash flow in foreign currency, first apply discount rate in foreign currency and then multiply by the spot rate. Then there can be a question, why we have not multiplied by the anticipated exchange rate given in the problem for next 4 years. We are not multiplying by the forward exchange rate, the rate expected in future, because there is a high degree of estimation involved. Sitting down today and estimating exchange rate after 1 year, after 2 years, after 3 years, 4 years is very difficult. That will involve more uncertainty. So instead of that, it is better to first compute the present value in foreign currency and multiply by spot rate, which will involve lower certainty than if you apply forward rate. Okay. So today we'll stop here. We have covered up to the estimation of cash flow. We'll continue tomorrow. If you have not got the notes, you please contact our office. Office number is 97669-21860, and they will help you with the notes. You can purchase the entire material on study material on accounting standard, which will have 30, 40, 50 questions on every accounting standard at one place. We have designed specifically for this upcoming exam accounting standard for intermediate. You can buy the video lecture which will have all the topics of your intermediate advanced accounting. Right now we are offering it only for 4,999, 4,999, which will include all video lectures of all topics, and you will also get hard copy of the notes. The lectures will be delivered to you, couriers will be provided to you, courier charges are free. Very economical, very affordable, and I am sure you will be able to purchase it. It's not a big amount, otherwise you are paying 15,000-20,000 rupees elsewhere and not having 50% of also what we have covered. You need 100% coverage in detail for your exam. Okay, I am also teaching financial management. You can purchase the financial management lecture also from our website vinod.in for 4,999, which is very reasonable, very affordable. It covers all questions of study material, RTP, MTP and past exams. Website is vinod.in and you can place your order today. Also, please inform your friends to subscribe to our YouTube channel. We are uploading accounting standards every day on our YouTube channel, and you can watch as many times you want, and you can watch on any device that you want. So there is no restriction on the device, there is no restriction on the number of times. You can forward it to your friends, share it with your friends, all your intermediate student group, so that they are also benefited. See, on YouTube it is free, it is for the benefit of the masses. Also inform everybody that you know about this kind of lectures. Okay, so thank you very much. I'll see you tomorrow.